What's good, y'all? It's your boy Sham, also known as the BJJ Lender. If you don't know by now, today we're stepping into equipment leasing. And I want to be clear from the jump. This is a more advanced strategy than most of what I've covered so far this season. This is not entry-level tax planning, y'all. This is not for everyone. This is for higher income earners who already have strong cash flow and are looking for depreciation, paper losses, and timing control. With that out of the way, y'all, please hit my damn intro. Let me set the frame properly. Most equipment leasing programs require a minimum investment around $50,000, which typically corresponds to roughly $500,000 of equipment exposure. That alone tells you this is not a starter move. This strategy is designed for high-income professionals, entrepreneurs with consistent profits, investors already paying significant taxes, people whose biggest expense every year is the IRS. If you're still stabilizing cash flow, this probably isn't your play yet. But if you're consistently earning 300, 500, 1 million, this is where strategy starts to get interesting. You don't teach flying triangles or flying arm bars to day one white belts. Same energy goes here. All right, y'all. At its core, equipment leasing is straightforward. Businesses like contractors, developers, farmers, logistics companies, construction operators, they need heavy equipment to operate, but they don't always want to buy it outright. Instead, they rent. As an investor, you own income-producing equipment that gets leased out to operating businesses. You're not running job sites, you're not managing crews, you're not fixing machines, you're owning an asset that businesses already rely on every single day. Here's where this becomes powerful for tax planning. The IRS allows you to depreciate income-producing equipment even if it's still working perfectly. That depreciation creates paper losses. Using Section 179, a significant portion, sometimes the majority, of the equipment's cost may be expensed up front. So even though the equipment is earning rental income, cash flow is coming in, your tax return may show a loss. That loss can offset other taxable income depending on your structure and participation. This is not magic. This is the tax code doing exactly what it was designed to do. In jiu-jitsu terms, top pressure again. No flash, just control. This part is critical, y'all. And this is where amateurs mess it up. To use depreciation against active income, you must meet material participation standards. That doesn't mean swinging a hammer. Participation can include reviewing operational reports, responding to leasing communications, attending owner meetings, making allocations or reinvestment decisions. And then there's Section 465, the at-risk rules. You can only deduct losses up to the amount you're actually financially at risk for. Cash invested, debt you're personally responsible for, no fake losses, no funny accounting, clean structure only. One of the reasons high earners like this strategy is capital efficiency. Instead of parking $500,000 in cash, you might deploy $50,000 and finance the rest. You control the depreciation on the full asset value while keeping your remaining capital liquid for other strategies. This is not reckless leverage. This is intentional deployment. Again, in jiu-jitsu terms, why bench press the whole weight when leverage does the work? Common sense, y'all. Rental income is paid periodically while the equipment is in service. At the end of the program, often several years later, the equipment is typically brought back at a predetermined value. Yes, that buyback can create taxable income, but by then, you've already deferred taxes for years. Use depreciation when your income was highest and often redeployed it into another asset. This is tax timing, not tax avoidance. Equipment leasing is rarely a standalone move. It pairs well with charitable planning, real estate depreciation, insurance-based strategies, business reinvestment. This is how high earners layer strategies instead of relying on one silver bullet. All right, y'all. If you're earning $500,000 or more and want to see whether equipment leasing fits your tax picture, book the consult. Notice how I said $500,000 this episode, not $300,000. There's a reason for that, minimum. We'll look at your income, your liquidity, and your timing, and tell you straight whether or not this is a fit. Like, follow, subscribe on YouTube, IG, and TikTok at the BJJ Lender. Drop a comment and share this with someone who really needs a smarter playbook. And as always, we don't just roll, we strategize. Until next time, it's your boy Sham, the BJJ Lender. Do what you got to do. See you next week.